Welcome to the latest episode of Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. So we finished February with equity investors being rescued by the Magnificent Seven once again. Those are those 7 key tech stocks, including Nvidia. Also, at the time, the year-to-date divergence in terms of the performance between global equities and bonds, with the former pushing to new highs while the latter fell in value, hinted at equity investors ruling out the possibility of a second spike in inflation and looking forward to that next part of the economic cycle and rate cuts. Now, with bond yields generally sitting near their 2024 highs, the bond market didn't appear so confident. Now, as we've moved through March, things have continued in a similar vein, with US equities demonstrated remarkable resilience, encapsulating the bullish sentiment that we have seen that's defined much of 2024. Now, this resilience was notably evident when the US stock market quickly recovered from the announcement that the US annual inflation rate had actually come in at 3.2% rather than 3.1%. Now, that reaction reaffirms the stock market's belief that we are moving more towards an era of rate cuts. They're more focused on growth prospects for the economy rather than inflation, and actually feel that inflation has already been peaked and therefore been defeated. So clearly, equity investors deem the economy in the US in a Goldilocks scenario, with inflation not too hot to be a problem and not too cold to cause concern about economic growth prospects. Now, despite the equity market's Goldilocks obsession, bond markets are still not as ready to dismiss the threat of a second wave of inflation, which has been evidenced by the 10-year US Treasury yield pushing back to its 2024 highs once again. And it's not been a great month for bond investors generally. If you want to look at that 10-year US Treasury yield, it currently sits around 4.3%, which is higher than the 4.18% level it started at the beginning of March. Now remember, higher bond yields mean lower bond prices. It also means that divergence I mentioned at the start of the show continues. That's the divergence between equity market fortunes and those of bond investors. And with the bond market dwarfing the equity market in size, it's always a brave investor who dismisses the bond market's concerns out of hand. But equity markets have also been emboldened by signs of improving market breadth in the US anyway, and that's been particularly notable throughout the month. And if you look at the S&P 500 and the number of stocks that are above their 200-day moving average, that percentage has been going up. So that is a positive sign, but it's only one measure of breadth in the US stock market. You can find others that are slightly less rosy. Now, if you have a well-diversified portfolio, you may have noticed that it's been other things that have been driving portfolio returns as well. So during the first 2 months of 2024, for example, you would have seen the Magnificent Seven were saving the day regularly and were driving returns. But since late February, it's actually, as a group, underperformed the wider S&P 500. And that's not necessarily a bad thing. It is actually a sign that we could be getting better breadth, and other sectors within the US equity market are starting to take over leadership. If that's the case, that could start to mitigate some of the concerns regarding the over-concentration of the US stock market. Don't forget, the Magnificent Seven account for 27% of the S&P 500 by market capitalization. As an aside, investment bank UBS recently published some analysis that showed that the US stock market is actually not that concentrated when you put it into a global context. In fact, the US is among one of the least concentrated stock markets of those analysed, and it may surprise you even further to learn that the top 10 stocks in the UK account for 36% of the total market compared to 25% in the US. But what does make the Magnificent Seven stand out is just how well they performed since 2023 as a group. They've risen by 13.5% since the start of the year up until about the middle of March, compared to 8.1% for the wider S&P 500. By contrast, in the UK, the top 7 stocks in the UK, when we're looking at the FTSE 100 on market cap, have fallen by 1.5%. Compare that to the FTSE 100 index overall. Over the same period, that has fallen by just 0.6%. So concentration risk is not a uniquely US phenomenon and is an issue in other parts of your portfolio too. But with US equities often being the largest constituents of any global fund, if you look, they're often about 60% of a fund's assets. You have to work a little bit harder if you want to diversify your portfolio away from the Magnificent Seven. But with the newspapers obsessed with the likes of Nvidia and other members of the Magnificent Seven and AI stocks generally, then people are overlooking other opportunities elsewhere. For example, in recent weeks, we've seen new all-time highs on the Japanese Nikkei 225, the German DAX, the Euro Stoxx 50, and of course the Indian stock market. Now, it also passed many by that gold has hit a new all-time high as well. And this has been mostly a result of the anticipation of interest rate cuts in the US. Meanwhile, the digital version, you could call it, in the form of Bitcoin, has also hit new all-time highs, but for very different reasons. Now, that's primarily because Bitcoin is riding a wave of demand after US regulators approved the sale of Bitcoin ETFs in January. Now, few other assets capture the boom, bust, and mania and despair of armchair investors as much as Bitcoin. And in 2024, the price of Bitcoin has gone parabolic. But investors haven't had it all their own way in March. In the last week, we've seen some of the exuberance being taken out of a number of established bull markets, including Bitcoin, whether by choice or by force. And that's not necessarily a bad thing. And I say by force because in reference to India, where the government has moved to stem over speculation in the Indian stock market, which has actually surged by 40% in the last 12 months. But with the US Federal Reserve and the Bank of England both announcing that they intend to keep rates on hold in the last 24 hours, and the Fed suggesting that there will be 0.75% of rate cuts this year, investors' animal enthusiasm has returned. And you can see that because the S&P 500 and the Nasdaq Composite both set new all-time highs yesterday. Even the Chinese stock market has entered bull market territory after being the global laggard. So, in summary, what we've been experiencing across investment markets is not just a rally in AI stocks, but a rally in almost everything. And if the Magnificent Seven are in a bubble, then there is an argument that almost everything is. And while risks are obviously rising, and that will feel uncomfortable, it's always worth remembering that market conditions like these that we're experiencing are the sort of market conditions where you usually make the most money. And I did some analysis for 80/20 investor members looking at the period of the last 4 months where my portfolio, which is broadly invested in about 60% equities and 40% other assets, had made over 11%. There'd been only 2 other occasions in history where we'd had such a rally in such a short space of time of just 3 to 4 months, and both of those occurred after events where people had been predicting Armageddon, and that was at the lows of the pandemic crash and also immediately after Brexit. So it just goes to show you when things can be uncomfortable, feel uncomfortable, that most of the returns from your portfolio over those last 9 years where I've been running that portfolio are actually experiencing very short periods of time. That doesn't mean there aren't risks, but it does also mean there are rewards. So that is it for this month on Damien's Market Update. As ever, if you enjoyed it, hit that like button, but also subscribe to the channel.